Today's job numbers look really good, and frankly, there's nothing in the job numbers today that say we're in a recession. Absolutely nothing that says we're in a recession right now. There's also nothing that really tells us we're going into a recession. However, there's plenty that tells us we are in a late stage of the employment market. And I'll explain what I mean by that. It's not something that's like, oh no, it's really bearish, but it's something to pay attention to because it sets up for potential weakness. And I'll show you exactly how to look for it. But first, we are now 13 minutes after the opening bell. And I'd just like to mention that this morning in the Alpha report, I mentioned that Robinhood, because of this tokenization drama, was probably going to lose its momentum. And as you could see, when I made that call in the opening, Robinhood fell right after that. I also made a call suggesting that it was really good that Symbotic was holding on to the 42.98 line, and it could be a breakout catalyst towards 50. As you can see, Symbotic is absolutely crushing it. Somebody in the chat here just actually reminded me of it. Thank you for saying that because they're like, hey, thanks, good call this morning. Now, can't always guarantee success, but the last few alpha reports, actually the last many alpha reports, I feel like have been killing it. And if you haven't tried it out yet, go to meetkevin.com. Check out the one-time payment option we have. You pay once and you're in forever. Now, let's understand what's going on with the labor market and why I say we're in a late phase of the labor cycle. It's very simple. Of the 147,000 jobs that we created, 90% of the gains came from healthcare and local government employment. In fact, 73,000 came from government. Usually when we're in a later stage of the employment cycle, the government is more capable of hiring. Note that local and county and state governments aren't affected by Doge. And so when the local governments can hire, it's usually when it's harder or when it's easier to compete against the private sector because the private sector really isn't creating jobs. And so when we jump into what we had in the labor report this morning, what we really saw was a labor report that barely showed us any private sector job growth. 10% or about 15,000 jobs were created by the private sector outside of healthcare and government. At the same time, what we've seen over the last 3 months is a very weird plummeting of the labor force participation rate. The labor force participation rate is really sensitive. We should pull up sort of a larger chart of it. So let's go ahead and do that. We'll pull it up on the St. Louis Fred database here. But as you can see, the labor force participation rate, it moves by decibels. So it moves like, it seems like it's a very small number that moves. But what we've seen in the last 3 months is we've seen this decline in the labor force participation rate by basically 1 percentage point, well, 1.1 every single month. And you start seeing that somewhat of a rotation down. Now, this could be due to many things. This could be due to people leaving the labor force because they're retiring. It could be because they're frustrated and they're discouraged, that they're not finding work, and they're saying, you know what, F it, I'll just not work. So retiring, leaving the labor force, or frankly, you could also be in an environment where you just find people are getting deported. And so usually when people leave, you want to pay attention to sort of balance out like, is this decline in the labor force participation rate an issue? You usually want to look at the 27 weeks unemployed level as well to try to understand how many people are just like, they want a job, but they just can't get one and they're more than 6 months unemployed. And you generally also find that the labor force participation rate stagnates or declines in recessionary environments, right? So just look at history over here. When you go into recessionary environments is typically when you get the downtrends. When you're in expansionary environments, you get the uptrends. So uptrends and expansion, either deceleration or stagnation in recession. Here you can see stagnation in recessionary environments, acceleration during periods of growth. So you can really see our growth period, 2021 all the way into 2023. And then in 24, we really started hitting a turning point. Now, sometimes it doesn't always equal recession, though, because, it's hard to say because look over here. 2002, 2003, early 2003, these were still environments where we were coming out of the dot-com bubble. So they could also be post-recessionary reverberations. You didn't really see the participation rate start expanding until 2005. And you could actually see the participation rate just kept collapsing following 2011 all the way out to 2015. So the participation rate isn't always a really useful tool to say, oh, we're definitely having problems in a recessionary state. This is why we like to look at the unemployment rate, the 27 weeks or more unemployed rate. We can see this has popped up again, but not meaningfully above our April high over here. We're just more of an environment where, yeah, we're getting more 27 weeks or more unemployed, but we're not at a level where we're, skyrocketing by any means. So overall, this is good. I mean, usually you see a skyrocketing 27-week unemployed level in a later portion of a recession. These higher reverberations at a more stagnated level, they could be symptomatic of a 2005 or 2006. And so when I say we're in like a later stage where you're getting local, state government hiring and you're getting healthcare hiring and very, very little private hiring, it just tells you you're probably somewhere in like a 2006, 2007-ish, like a 6, 7-ish, somewhere on there. Not necessarily some kind of recessionary 08, 09 collapse. So overall, this is a good thing. This is one of the reasons why we saw the unemployment rate go down. It's one of the reasons why we're seeing the odds of a rate cut in July now basically get crushed. Now, what it does set you up for is potentially a layoff cycle. Of course, but that's always the concern, that we would have some kind of layoff cycle that comes. And really, we're just not seeing that many announced layoffs. Yes, we're seeing these sort of rolling announcements that get these, breaking news headlines. Microsoft lays off 9,000 here or there or whatever. But what you really need to get a real layoff crisis is some kind of shock where small businesses across the board are going, I can't handle it anymore. I have to lay off. And we're not seeing that, which is frankly very good. So 147,000, obviously better than expected. People talk about revisions. We actually revised last month's employment numbers up. Now, in fairness, in August, we get these 6-month revisions, which last year were so negative on an entire half year that we ended up having a really nasty August. But there's nothing to say in these last 2 employment reports that is very bearish. It's very hard to find anything bearish in here. Yes, you could look at the households numbers. The households dropped about 130,000. So, yes, we are seeing fewer people participate. The labor force is shrinking. Household number down, labor force participation down. Both of those numbers contributing to a weaker market when it comes to getting a job. But again, the one thing that makes that beverage curve so weird, the lack of layoffs. And that's the same thing that's keeping the unemployment rate now moving down, because we're not seeing the layoffs. And potentially while people are exiting for deportation reasons or retirement reasons or whatever, it's nothing to really say there's this huge negative scary catalyst. And that's why I think what we're seeing in markets broadly is that the 10-2 yield curve is actually moving in a direction of less shock. So you can see the 10-2 curve, I'll pull that up here. The 10-2 curve right now is sitting at 46, 45 now, which is significantly lower than what we saw yesterday. Yesterday, we were starting somewhere around 55 to 52. Then we got the Vietnam trade deal, which is good news. It's the first trade deal that we have with a deficit country. Fantastic, finally. Now, yeah, the rates are higher than we expected. Is it good that we have a 20% tariff rate on Vietnam? In my opinion, no. It's going to create deadweight loss. It's going to show up in earnings somewhere. But does it matter? Does Amazon care? Does do the consumers care? Probably not. Who's probably going to care? Probably the companies that have to import, like the Nikes. They're going to have to beat up their manufacturers, and they'll probably eat some of it too. Now, is that an economically horrible thing? No. In fact, we're making progress, which creates certainty. Now you get certainty on tariffs, you get certainty on jobs, reduces the urgency for the Federal Reserve to panic cut. However, I do think the Federal Reserve, like Jay Powell, he's going to look at these numbers, he's going to go, these are numbers that they basically guarantee us that we are not going to be resilient against layoffs. Because again, we only created 15,000 private sector jobs outside of healthcare and state and local government, which is very, very weak, right? So that's why I say late cycle. So think about it sort of like the business cycle. You know, you're not like in the crash portion, but you're just sort of like, you're on that curve where you're not growing. You're not on the growing side of the curve. You're on sort of the slowing side of the curve. Does that mean things are going to go crap tomorrow and sell everything? No, of course not. But does it mean we're prone to very crappy labor reports if people started losing their job? Yeah, but that's been a big if for like a year now, right? We've been waiting for these layoffs and they frankly haven't come. So, which is good. Overall, it's a bullish thing for the economy. So we'll see. We'll see how things develop. All I know right now is Symbotic keeps kicking butt. And actually, if you think about it, the labor market and the labor market surveys that we're getting might actually be great for a company like Symbotic, because Symbotic is a robotics company. And I don't want to hijack a jobs report discussion to talk about Symbotic, but I kind of like Symbotic. So I've been doing fundamental analysis on Symbotic for a while now, not only on the YouTube channel, but in our course member live streams. We've been talking about this one for a while. Symbotic's a very interesting company because in an expansionary economy, this is a really fantastic company, because what you have is you have essentially the robots that support warehouse infrastructure. So think Walmart. Walmart's expansion in Mexico, Walmart's distribution centers in America, other companies like Target that start waking up and realizing, wow, we need robots, we need to adapt. Obviously, Amazon buys a lot of its own robotics companies, but Symbotic is sort of the way to roboticize your warehouses if you don't have that internal stack. And in an environment where we're moving away from more expensive labor towards more AI and robotics, I think Symbotic is a very interesting play, and I don't think its valuation is so terribly unreasonable. Let's run the valuation on it, though, because it's been a minute since I've run the price earnings on it. So let me see here. So Symbotic, you're only looking at like 10 cents of earnings, but the earnings are expected to explode for it. This is based on Wall Street's expectations, right? So let's look at 46 divided by, let's see here, 46 divided by 10 cents. Yeah, I mean, technically for this year's PE ratio, it sits at 460, which is crazy, right? Because their earnings are 10 cents, because you're coming out of a loss. So that's something to keep in mind. When you transition from loss to positive, you're always going to have what looks like a very expensive PE ratio. However, that's expected to get to 41 cents in 26. It's expected to get to 89 cents in 2028, $1.50 in 27, $1.55 in 28, and $2 in 2029. So on an EPS growth basis, EPS growth is expected to grow 305%, 116%, 74%, and 33% divided by 4. You're looking about 132 on a growth rate for EPS expected. So if you divide that out, you're sitting at about a 3 peg. It's getting a little bit on the pricey side. And this is why I liked it so much when it was over here on the 20, because it was trading for like a 1.5 peg, right? That said, right now it's got momentum. And that's always a funny transition where you go from like, wow, this is good fundamentals, to, whoa, it has momentum. And that's going to be something to pay attention to in an environment where we continue to see expansion of markets, because we're not getting bad data. People are going to be really looking for momentum plays and things that do benefit in an expansionary environment. I mean, it's one of the reasons I think Amazon is up today, because, hey, good jobs mean more people can spend, right? Maybe government jobs, healthcare jobs, there's still jobs. Private sector really isn't hiring, but people are trading Amazon up, which is suggestive of potentially warehouses trading up as well. Something interesting to pay attention to. But that's sort of my distillation here. Not great, not terrible. That's sort of like the Chernobyl line that I keep referencing. But it's important because it is true. This is not an economy that's creating jobs everywhere. These are not broad-based gains. These are the late cycle reports that show us that we are indeed prone to problems. but those problems could be months away or they could be years away. There's really no way to bet on that. So we'll see. Anyway, as far as the Fed and the odds of them cutting, I know that's something that's been interesting. So we are now at a 6.7% chance of cutting for July. Now, this is actually quite remarkable. We went from almost entirely pricing in a guaranteed cut in September to now only having a 69% chance. So a 2/3 chance of cutting in September. So you've really seen a plummet in the odds of a rate cut, not only for July, but also for September. As far as data that's coming out, we did just get S&P Global Services. They came in slightly weaker than expected on the services side, composite fractionally higher, both in the expansionary territory, so not necessarily anything to phone home about here. S&P services read, okay, broadly in line over here with expectations. Okay, so that gives us an overview of some of what's going on this morning and my take on it. Again, check out those courses over at meetkevin.com. Look at that, Symbotic's now almost up 10%. This is remarkable. Almost up 10%. That's serious momentum over here. And again, if you want this sort of heads up, remember, I sent this signal out here before any of the explosion, which is kind of cool. Check out the Alpha report if you haven't yet. And if you're an existing course member, remember, you can actually use the Meet Kevin app to get your Alpha reports, which is great because you don't have to rely on like YouTube or Discord notifications or whatever, some other app. It's through there. You can customize your notifications. If you're not a course member, you can get the Meet Kevin app too if you want. It just doesn't have the Alpha report because that part's for course members. And as always, if you ever have any questions, you can email staff@meetkevin.com. I guess we may as well look at ISM services as well because those come out in about 10 seconds. So ISM services, slight beat, prices paid comes in lower. That's good. New orders, big beat. Employment misses. But new orders, that big beat, that's bullish. So another both of these data reports here on the surveys, which are technically soft data, S&P Global and ISM Services, both of these good, especially since you have better than expected prices paid there on the ISM survey, which is fantastic. These are things you want. This is good for the market and the economy. And look at that. Qs keep kicking butt, which was also in our Alpha report this morning. Bearish hood, bullish Qs, bullish Symbotic. And I also said that I thought Tesla might get stuck under 318, that there wasn't really a catalyst for it to collapse, like it wasn't a short catalyst, but it was, not something that necessarily was primed for a breakout today. I don't know. Alpha Report's got something cooking today.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.